Right now, the Indian IPO market is running incredibly hot, and Tempsens Instruments is catching a massive share of that momentum. Before a single official share has traded, the gray market is projecting a 58% listing premium for this stock. The company generating this demand is a 34-year-old manufacturer based in Udaipur. They build precision thermal engineering solutions and highly specialized cables used in heavy industry. To scale their operations, they are coming to the public markets to raise 650 crore rupees, with a target listing date of August 28, 2026. Look past the initial excitement, and you will find a massive structural catch built into this offering. 85% of that capital is going directly into the pockets of early investors and promoters cashing out, not into the company's actual growth. We are going to strip away the gray market noise, evaluate the actual business fundamentals driving these valuations, and deliver a definitive apply or avoid verdict based on your specific investor profile. Navigating this specific offering requires you to make a choice up front. You are either playing a short-term momentum game or you are buying into a long-term hold. The retail application window runs strictly from August 20 to August 24. To participate, you have to commit a minimum of 15,000 rupees to secure a single 50-share lot. That commitment ties up your liquid cash for nearly a week, with no guarantee you will receive an allotment when shares are distributed on August 25. The metric driving retail frenzy right now is the gray market premium. Dealers are quoting a premium of 175 rupees on top of the 300 rupee upper price band. The gray market is entirely unofficial. It is an unregulated sentiment tracker, not a legally binding financial contract. If the broader national index experiences a sudden sell-off, these unofficial premiums evaporate overnight, leaving retail applicants holding shares that list flat or even negative. While a high GMP proves there is massive initial retail demand, applying means you accept full exposure to market-wide volatility between the day you lock up your cash and the morning the stock officially lists. The underlying business is robust. Tempsens currently controls a dominant 10.5% market share in the domestic contact temperature sensor market. Their primary economic moat is even stronger. They hold a 100% domestic manufacturing monopoly in non-contact temperature sensors, known in the industry as pyrometers. These are highly specialized instruments required by heavy-duty operations in petrochemical refining, heavy steel manufacturing, and aerospace engineering. These industries constantly wear out their equipment. Because of this, roughly 32 At 300 rupees per share, the company is demanding a steep price-to-earnings ratio of 35.38. This pie chart breaks down exactly where your money goes in the 650 crore IPO. The massive red slice is a 555 crore offer for sale, while the tiny green slice is the 95 crore fresh issue. That small 95 crore fresh issue is not entirely dedicated to expansion. The company is using 55 crore to prepay existing debt, leaving a fraction of the total IPO proceeds to fund new capital expenditures. You are paying an expensive premium valuation primarily to provide an exit for existing promoters, rather than aggressively funding new corporate growth. You have undeniable short-term IPO momentum, weighed against an expensive valuation and a massive promoter cash-out. To resolve this, we break the decision into 3 specific paths. For the listing gain flipper, the verdict is apply. With a gray market premium pushing nearly 60% and a relatively small issue size, retail demand will inevitably outstrip supply on opening day. For the long-term holder, the verdict is apply, but monitor closely. The expensive 35 times multiple is uniquely justified by their 19